Well, hello there. I'm Gemini.
Okay, so what you just saw, that's not just a collection of tips or some hot stock picks. Think of it as a complete operating system for investing. It's a disciplined, rule-based framework built for one single purpose: long-term compounding. So what we're going to do is deconstruct this system piece by piece so you can really understand how it all works together.
All right, so where do we even begin? Well, with any good system, you have to start with the core philosophy, right? Before we touch any numbers or rules, we've got to get our heads around the foundational mindset. And the entire framework, the whole thing, is built on this one powerful idea: being a lifetime accumulator of high-quality businesses.
This right here, this is the foundational principle. It sounds simple, but it is such a powerful mental shift. It's all about tuning out the constant noise of the daily market. The goal isn't to predict where a price is going tomorrow or next week. Nope. The real goal is to build ownership in great companies steadily over a lifetime. Getting this one sentence right changes absolutely everything about how you invest. This defines both the time horizon and the main objective. We're not looking for a quick win here. This system is engineered to harness that patient, almost unstoppable force of compounding. It's all about building wealth methodically over decades, not days. It's slow, and it's relentless. And this might be the most important part of the entire mindset. The system prioritizes survival and discipline above everything else. Look, winning in the long run isn't about hitting home runs. It's about avoiding those catastrophic mistakes. It's about preserving your capital during the bad times, and most importantly, controlling those emotional impulses that cause so many investors to make bad decisions.
Okay, so we've got the philosophy down. Now, how do we find the right businesses to accumulate? Well, the system uses a series of really strict sequential filters. You should think of them like quality gates. A company has to pass through each one in the right order to even be considered.
And the order here is absolutely critical. We start with the single most important factor: earnings. Only if a company passes that test do we move on to assess its return ratios, the durability of its business model, and finally, the strength of its balance sheet. So let's break each of these down.
The system is earnings first, period. Before we even think about the stock price, we look at the business's engine. We're searching for consistent growth, both in revenue and profit, quarter over quarter and year over year. And crucially, we assess the quality of those earnings. Are they backed by real cash flow? If a company has poor earnings, it's an immediate disqualifier. Game over.
So once a company proves its earnings power, we can move to filter number 2, efficiency. And the system sets a very high bar here, demanding a return on equity or return on capital employed of over 20%.
Now, you might be wondering why that specific number? Well, it's because a consistently high ROE or ROCE is a really powerful sign of a superior business. It tells you that the management team is exceptional at turning the company's resources into actual profit, which of course is the very engine of compounding our wealth over time.
The final 2 filters are all about resilience. Think of them as a stress test. Filter 3 looks at the durability of the business model. Does it have pricing power? Is it asset light? And then filter 4 examines the balance sheet. Is leverage conservative? Is this a business that can survive just about any economic storm? Only a company that passes all 4 of these gates gets considered for accumulation.
So, we've identified a high-quality business. Now what? How do we actually buy it? This is where the operating system truly shines, because it replaces our emotional, gut-feel decisions with a predefined, rule-based execution plan.
And this table right here, this is the system's logic in action. You can see there are different modes of accumulation, from sniper all the way to ultra-aggressive. And each one dictates a specific number of shares to buy per day. This isn't based on how you're feeling, it's a preset plan. The default pace is slow and steady, which prevents you from going all in right at the top.
And here is the core behavioral rule. The system is designed to act as a counterweight to our own instincts. It gets more aggressive precisely when the market is falling, when the headlines are negative, and when other people are scared. You only escalate from balanced to aggressive based on market conditions, not because you're feeling excited. This is what behavioral control looks like in practice.
Now, this aggressive buying is only possible because of strict risk management. The system forbids using leverage, it demands you have an untouched emergency fund, and it makes sure you build your positions gradually. These are the non-negotiable guardrails designed to keep you in the game for the long haul, making sure that a period of market fear doesn't become a personal catastrophe for you.
So when you pull this all together, what's the true purpose of a framework like this? Well, it's not about owning a crystal ball. It's about enforcing discipline.
especially at those moments when our own human nature might lead us astray.
This slide draws a very clear line in the sand. Most of the financial world is absolutely obsessed with predicting what the price of something will do next. This system, it completely ignores that game. Its one and only focus is on the process of relentless accumulation and compounding.
And this is really the ultimate takeaway. Investing for the long term doesn't have to be exciting. In fact, this system argues that it probably shouldn't be. A methodical, unemotional, and maybe even boring process, when you repeat it consistently over decades, has a much higher chance of success than just relying on flashes of brilliance or gut feelings.
So this brings us to a final question for you to think about with your own approach. Is your investment process built on the fragile goal of predicting the future? Or is it built on the robust foundation of surviving whatever the future brings, so you can just keep on relentlessly compounding for the long run?